Is this the start of a longer of a longer correction, or is it also a bit of a funny day just because it's August?
Well, I think it's probably the beginning of something. And again, the corrections are normal; they're healthy. We haven't, as we all know, we haven't had more than a 5% pullback all year this year. That's very odd. Usually, that doesn't happen. But the thing for me is that again, this whole thing with inflation, you're having a situation where people are worried about the economy slowing down, even though it may not be anywhere near what we saw a slowdown last year. But like I said, back in the 1970s, we had stagflation because the inflation issue was not because of demand; it was because the supply. They cut the supply of oil and prices went up. This time around, it's this whole supply chain issue that is causing prices to move up, and that looks like that's going to continue longer than people had thought. So that's right now.
Matt, the moves we're seeing in the market today are accelerating. The Bloomberg Dollar Spot Index now at its highest since November. The CAC 40 over in France extending its losses now to 3%. With all of this going on, where do you hedge?
Well, that's always difficult because when a market is extended, and I say it's overbought and expensive, that makes it really tough because I've been hearing all sorts of stuff about people saying the rally of everything, and a lot of people saying would continue to the end of the year. Well, if everything's rallying, what's going to happen when things go down? It's hard to hedge yourself. Number one, I think the biggest thing is just raise a little bit of cash. That doesn't mean going to 50% cash or even 20% cash, but it does allow you to keep your head if the market comes down and be able to buy on weakness and not be selling at the exact wrong time.
I was going to say, why not just buy the dip here? I mean, the CAC 40 falling more than 3% because it's got all of those luxury retailers. If they're taking a big hit today, doesn't recent history tell us they're going to bounce back with strength? Yes, recent history tells us that. But intermediate term history says just the opposite. Again, we haven't had a correction. We haven't had a pullback of more than 5%. You know something? I think 2017 is the only year in the last decade where we haven't had at least a 10% correction. So the odds of us having a correction this year are every year are very, very high. So I think people have gotten lulled into the fact of just thinking, oh, just every little dip I've got to buy. This is really only a small dip right now. And I just think people need to be more careful.
So are you more excited about volatility right now? I know the VIX from a low base is actually moving upwards, or do you worry about liquidity?
No, I mean, again, it's not like the Fed is completely exiting their QE program. They're just making it more difficult for us to sustain these higher valuation levels. So, yeah, I think volatility is going to be up. You get people who want to play in the VIX options is something that you can play in, but as a hedge. But the real thing is that this is more normal. It's healthy. Stay calm, embrace the pullback, but just know that there's a good chance it'll be more than the normal 3 to 5%, or what's been normal this year is 3 to 5%. It could be more.
So, Matt, if you had to make a growth versus value call for the final 3.5 months of the year, what would it be?
Definitely value. I think that we're returning to that situation that we had from August of last year until March of this year. This tapering back of QE will eventually cause rates to move a little bit higher. Right now they're going down because of flight to safety. They'll go a little bit higher. That's going to be tough for technology, tough for growth. That's why I like value for and into next year as well.